Hi, and welcome to the ECIO market commentary for the month of July. July was a mixed month for U.S. equities as we saw indices modestly negative to up 5.5% for dividend stocks, small cap stocks down about 3%. Overseas were also mixed. Developed non-U.S. stocks gained 2%, while emerging market stocks were down 3%, and fixed income results were negative during the month as longer dated interest rates rose. Year to date for the 7-month period, results are very strong for stock investors in the US, up 10 to 24%, overseas up 11 to 20%, and for fixed income investors, flat to modestly negative. Over the past 12 months, the S&P 500 has returned over 19%, so it has been a tremendous period. There has been a fair amount of volatility. Starting at the end of February with the conflict in Iran, we saw a pretty significant sell-off, followed by a rebound driven by strong corporate earnings and optimism over AI. From a sector perspective, during the month, we saw energy stocks gain over 12%. Meanwhile, technology stocks and AI-related stocks were generally negative. The technology sector lost 3.4%. So once again, the S&P 500 essentially finished flat for July. But there was a pretty good rotation in the market. We saw the Russell 1000 Value Index gain 3.8%, while the Russell 1000 Growth Index lost 4.8%. And again, small cap stocks lost about 3%. Developed markets outside of the US performed well, up about 2%, while once again, emerging markets lost over 3%. The Bloomberg Aggregate Index lost 1.3%, so that's fixed income. We saw longer dated interest rates rise. The 10-year Treasury yield reached 4.75%, and the 30-year jumped to 5.3%. The Fed did meet at the end of July. They voted a mixed vote, 9-3, to hold interest rates steady. That's the first time since 2016 that 3 officials have dissented in the same direction. So there's not unison today amongst the Fed members. Traders have put the odds of a September rate hike by the Fed at nearly 100%. So the market is expecting that the Fed will need to increase short-term interest rates this fall. On the economic front, second quarter GDP was reported at 1.5%, so that's down a bit. Also, tariffs were announced under a new section, 10 to 12.5%. Those replaced some of the expired tariffs on our trading partners. Inflation, June consumer price index came in at 3.5%, so that is down from 4.2%, which was May's reading. Core inflation, excluding energy and food, came in at 2.6%. Meanwhile, consumer confidence slipped. That's the third straight month that number has come down, even though jobless claims in the job market appear to be relatively strong. Meanwhile, the market has been focused on geopolitics, in particular, the Middle East conflict. Renewed fighting has halted tanker traffic through the Strait of Hormuz, and it has resulted in oil prices, WTI, which neared $85 at the end of the month, up from $70 in June. That also pushed gas prices up over $4 a gallon and was responsible for lifting the energy sector up over 12%. So as we look forward, we think investors are going to be very focused on earnings. So far, the earnings have come in pretty strong. 86% of the S&P 500 companies have beat estimates. So that will be weighed off against a slowing economy, energy-driven inflation, and concerns over whether or not the Fed will act in time to stave off inflation. So that concludes our brief update for the month of July. If your investment committee has any questions or would like to meet with us, please reach out. Thanks for your time and interest. Have a great day.